Hello guys, this is your boy Sbac here, and in this video we are going to talk about the three most important, I think above all, the three must keep rules for proper risk management, a good and a correct proper risk management. All right, I'm gonna show you everything on the chart. Okay, now what I'm saying is this: do you know how sometimes traders comes on YouTube or even on other platforms and they be like, oh guys, if you're trading, make sure you keep a proper risk management, and they say all of that, and in reality they never show you how this whole risk management system works. Guys, it's an agglomeration of a whole lot of things. Today I will break down in this video the three most important risk management rules that you guys should keep that will make you a very successful and a profitable trader on a long run, and helping you to keep your risk management in check. All right guys, so if you're excited about this video, click the thumbs up and make sure that you subscribe if you're a new subscriber to this channel. Okay, without further ado, let's dig into the chat. Okay, so guys, here we are on MT5, and the first one that I'll talk about is the most popular one. It's the most popular one that you guys have heard a lot of times, all right, which is lot size. Guys, it's true. It is very important. Guys, you need to know your lot size in commiseration to your stop loss and your take profit. Okay, especially your stop loss, because as a trader, what should be the most important thing to you every time that you are entering into a trade is how much you're losing. Okay, and you would know that based on the lot size that you've put in, all right, together with the pips distance and all of that. But at the end of the day, the lot size is very important. So guys, if you have a small capital and you're using a big lot size, it is very easy. If you're using a big lot size, guys, it's very easy for you to blow your account. All right, just in a split of seconds or in a minute or some few moments. Okay, because let's assume if we take a trade here, all right, if we take a trade here, we enter into the market right here. Okay, let's assume we entered into the market right here and we use a very big lot size. Okay, let's say maybe we use the 0.20, okay, and we have 100 euros, okay, or 100 pounds or 100 US dollars in our capital, and we open a 0.20 or a 0.30 lot size. Guys, believe me or not, you won't even last up to, let's say, 60 pips or 50 pips, and you'll be kicked out of the market. Why? Because the market, if the market reverses against you, okay, and it drops down to 50 or 60 pips, guys, you could be out of the market, and you don't want that. Okay, you want to have a longevity in the market. You want to grow your profit on a consistent basis. Okay, I know many people use that as a strategy, but I don't advocate that. Okay, unless you wanna squander that money, you are ready to lose that money, you don't care about it, you just wanna have an experience with it or experiment it, then go for it. All right, so that is the first one that I would say. Okay, guys, if you don't know much about lot sizing, okay, let me know in the comment section or reach me on Instagram and write me. Okay, I'll help you with that. It's very important. Okay, now the second thing that I will talk about is, guys, stacking of trades. Okay, stacking of trades. Guys, you want to watch to the end of the video, because these are secrets that people don't tell you, traders don't tell you, and sometimes you get too lost in the euphoria of trading, the fun in trading, and at the end of the day you lose your money and you are like, but what happened? Because you didn't understand some of these things. Okay, so the second thing is stacking of trades. Okay, so guys, look, now I have a 0.05 lot size. Okay. Now, if I put in 0.0, if I put in, let's say if I'm having a capital of, let's make it simple, right? If I'm having a capital of $50, okay, or $20, right? And I put in 0.01, okay? I have a capital of $20 or $50, okay? And I put in 0.01, okay? And guys, if I press sell 5 times, that means I'm using, even though it's 0.01, but in reality, what I'm trying to imply here is I'm using 0.05 lot size. If I press sell 10 times with the 0.01 lot size, I'm implying that I'm using the 0.010 lot size, okay? Now, this form of trading, using the small lot size to enter into many trade, like to compound, stacking trades using a smaller lot size, has its own advantage. And here is its advantage. If you are using a big lot size, all right, if you are using a lot size, let's say 0.10, guys, the moment you press sell or buy, that is it. You can't remove some of your positions and say, okay, now I want to drop it down to 0.05 because I see that the market is going up, the market is going against me. Like as we are seeing right now, you see, if we entered in here with, let's say, 0.10 lot size, okay, now the market is going against us, okay. Now you say, oh, I want to remove some of my positions, and maybe let's say I want to remove 5 positions and bring it to 0.05 lot size. You can't do that when you write here 0.10. When you write in here 0.10 and you take a position, you can't drop down to 0.5. That leads to the advantage of using smaller size like 0.01 to stack trades. All right, to stack trades. So what happens if you see the market going against you like this? Then you can say, okay, all right, let me take off 5 positions. So you accept your loss. That means you are accepting your loss. So you remove 5 positions, you close it. Bam, 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 bam. And you close your 5 positions and you leave 5 positions in till it hits your stop loss or whatever thing you did. All right. But as I told you, this is the second thing. Okay. This is the second risk management that many people don't realize, because you have a lot of people that when they see a good market, then, like here we see a double bottom, right? Okay. We see a double bottom. So let's say that, okay, the market crossed here. The market broke the neckline, okay? And we entered into the market here, okay? We didn't wait for this reversal, okay? And we entered into the market here. And now the market took us into profit. We are seeing a lot of money, okay? Now, guys, if my capital is 20 pounds or $20 or $50, and I don't have a good plan, strategy plan, or a budgetary plan attached with what I'm doing here, guys, now you see that the market has gone up, right? Good. Now it's just reversing. Let me take this. Now, guys, we are losing money here. Okay? At this point, we were making money, but now we are losing money because the market is reversing. Okay? Now, if it happens that the market drops down to this level, or maybe to a 20 pips below, or a 10 or 20 pips below, or 30 pips below, guys, there is a likelihood that we can lose all our money. Why? Because we stack a lot of trade. So the moment the market goes against you just a little bit, you lose it all. Now, this rule goes for even when you have, let's say, a capital of $100, a capital of a balance of $1,000, $500, $5,000, $10,000. If you're trading with $10,000 and you keep on stacking with a lot size, a standard lot size, 1.00, guys, and you stack like you stack like 10, 20 positions, 15, 30 positions with a standard lot size, bro, you won't last long in the game. If the market reverses against you, let's say 20, 30, 50 pips, you could be kicked out of the game. Do you understand me? And you should remember that every lot size that you put in, the broker will, every position that you take in, you put in, the broker will charge you a commission or a spread. You see? Now that is the disadvantage. That's the disadvantage of stacking position. That is where using maybe let's say 0.10 lot size, okay, a micro lot size is advantageous than stacking 10 positions, because these 10 positions, the broker will charge you per each position a commission or the spread. But when you go in with just a lot size, one lot size, having that position, then the broker will charge you just one, okay, for the spread, for the commission, okay? So guys, you should watch out for the stacking. If you are stacking, you should know what you are doing. If not, you are going against the grains of what a proper risk management rules requires. Okay, guys, if you didn't understand this part that I did explain, guys, let me know in the comment section, all right? And I will try my best to explain it to you, okay? Or write me on my social media platforms. Write me and I will do my best to attend to you guys, okay? I will answer all your questions and help you, even on a one-on-one session, okay? Good. Now let's move to the last one, which most of the times it's quite tricky. Not many people realize it, okay? Now, what am I talking about? The last one is, guys, if you have a capital of, now let me lay it down straight. The last one is opening different positions in different currency pairs. Okay? You should realize that opening a different position in different currency pairs is you having your money being taken for each one of these positions. So it's something similar like stacking in this currency pair. It's similar like stacking, putting different positions here in this currency pair. But what you are doing this time around is that you are not doing it in this currency pair alone, but you are taking one position here, another 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 position here. So what happens, guys? What happens is that if the market begins to go against you in all of these markets, or in a huge part of these markets, okay? And guys, if you are, let's say, if you are not having much money as balance in your account, then you will see that you can be kicked out of the market. It's very, very important that, guys, you understand this, that this is the capital that I have, and I can only allow myself to take this amount of trade, this number of trade, this limited amount of trades. I can only enter into these pairs, because you need to remember that each pair varies in terms of the money that you are going to risk. It is not equal in all of the currency pairs. Sometimes they happen to be equal, but most of the times there are some cents difference, and sometimes or cent or penny difference, or sometimes there are, a big chunk of differences. Do you understand me? So you want to watch out, okay? The third thing I said, I repeat it, okay, for clarity purposes, is don't open maybe, let's say, 2 trades here, 1 trade here, another trade here, another trade here, another trade in gold, another trade in New Zealand JPY, Japanese yen, and another trade here. Are you calculating your risk? Do you know how much you are putting your capital on the front line? Do you know how much you are exposing your capital to risk by doing that? Because if all the positions that you've taken in that market, in these different pairs, if let's say for some, I don't know reason, if there is a political event and the market begins to reverse against your direction in all of them, whether you did buy, sell, whatever direction you did, if the market begins to reverse against them, guys, you are losing money. You will be losing money. The market will just have to go, some few pips below your entry point, and guys, you will be kicked out of the market because you are losing market. You'll be losing money here. 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 Do you understand me? There is a good side to this, trading in different pairs, but you have to know what you're doing. You have to have your technical analysis, your fundamental analysis checked. Then you can jump into the market and do something like that. All right. So guys, these are the 3 proper risk management that gurus, Forex good traders, and other YouTubers don't tell you. They just tell you, guys, keep a proper risk management. Make sure you keep a proper risk management. But guys, if you don't know these things, you will blow your account quick. You will blow. It doesn't matter if you have a big account or you have a small account. If you don't know these rules and you begin to open trades here and there, thinking that the market will go in your direction, guys, the market just have to go a little below your position, and home you go. It's called. All right, guys, I thank you for watching this video. Guys, if there is anything that I didn't say, make sure that in the comment section you put it there so that it can help me, it can help the community or the people that are subscribed to the channel. I thank you very much for your time. Make sure you follow me on all my other social media platforms so that we can connect together. Thank you, guys, and I go by the name Sbac. I approve this concept too. All right, see ya. Signing out.